we had done in the last class was the chapter 6A deductions, right? We had studied all the other chapter 6A deductions. We were left with some of the chapter 6A deductions, which were, good evening, Jyoti, which were concerning the deductions in respect of certain income. Isn't it? Yes or no? So today what we are going to start with is the deductions in respect of the incomes. Right? If you remember, I had told you that there are certain deductions which are available in respect of the income, isn't it? So today we are going to start with those particular deductions. Yes, Yogesh, we are going to start with that. Samnathan, good evening. Okay, so if I take you back to the start of our class, and if you have a look at it, so today we are going to cover these income-based deduction, which is ATIA to ATIBA, ATIAC, ATLA, ATQQB, ATRRB, ATM, we had already covered, isn't it? ATTTA, ATTTB, we also covered. ATP, ATPA, we will be covering in the assessment of various entities with the cooperative society, or if the time remains today, we'll cover it today also. Fine. So let us quickly start with these income based deduction. Let me also share you the module. One second. Do let me know if it is visible to all of you. Yes? Is the screen visible to all of you?
No, ma'am. No, ma'am.
No? One second. Now is it visible to everyone? विजिबल नहीं हो रहा है मैंने तो शेयर किया हुआ है अच्छा एक सेकंड मिनट
Yeah,
में
visible.
आया
Visible.
Visible.
आ गया.
ओके मैं एक बार इंटरनेट भी चेक कर लेती हूँ ओके so let us start with the first deduction which is in respect of the ATIA. Let me start with that. Yeah. So deduction under 10 AA is what we'll cover after ATIA, IB and all of that. Where is it in the module?
$8.57 page number.
8.57. Yep. This is what 8.4. Yep. Thank you so much. So, deduction in respect of profit and gains from the undertaking or enterprises engaged in infrastructure development. Okay. So, if you see, it says deduction in respect of profit and gains from the undertaking. So basically, these deductions which are given under ATIA, ATIB, all of these sections are linked to the profitability students. These are linked to the profitability. So this is to incentivize these kind of businesses that this particular deduction is provided for. So what does ATIA says? ATIA provides a 10-year tax holiday to an assessee whose gross total income includes any profit and gains derived by an undertaking from an eligible business. So if the undertaking has the profit from this eligible business, then in that particular case, you can claim the deduction under section ATIA. Okay, and what are the eligible businesses? First is infra facility. Developing, operating and maintaining, developing, operating and maintaining infra facility. Either developing the infrastructure or operating and maintaining the infrastructure or doing all of these three. And if these enterprises are owned by a company registered in India or by consortium of company or by an authority or board or corporation or any other body established under the central or state act, and it has entered into an agreement with the government or local authority for developing, operating and maintaining the infra facility. Are we getting it? So basically, an Indian company carrying out these activities of developing, operating and maintaining the infrastructure facility, and it has entered into an agreement with either local authority or the government. Right? So in that particular case, it can claim the deduction under ATIA. Or where the enterprise which develops the infrastructure facility transfers it to another enterprise, and the other enterprise operates and maintains in accordance to the agreement with the government. So even if the business is transferred to some other entity and that other entity enters into the agreement with government, that's fine. Now, what are the infrastructure facility? Road, including toll road, bridge, railway system, port, airport, inland waterways, inland ports, navigation channel in the sea, highway project, housing projects, which are part of the highway project, water supply treatment, water supply project, irrigation, sanitation, sewerage system, solid waste management system. So these are the kind of infra facilities. So either you are developing this or you're operating and maintaining it, or you're developing, operating and maintaining it. So basically this is to boost the infra facility. This is to give incentive to the businesses to enter into this particular infrastructure development, and they can claim the tax exemption. Are we getting this? So basically the businesses which are into this line. So I've put up a chart over here also. What are the eligible businesses? Developing or operating and maintaining any infra facility owned by the Indian company. Here you can just write it down, Indian company instead of just company. Sorry, give me a minute. I think this is disconnected. Is agreement with the Indian government. Secondly, what it says is structure at the ports for storage, loading, unloading will also be included in the definition of the port. So any kind of structures which are developed at the port for the loading, unloading, like inland container depots, are also eligible for reduction under ATIA. Right? So any effluent treatment, Conveyance system is a part of water treatment system. Even that will be available. The widening of the existing road is also covered for the purpose of the ATIA. That would be regarded as new infrastructure facility. So you would have seen that, on roads, there are certain plots which are there, which are taken over and the existing roads are widened. So anybody who is engaged in development of that, operation of that, maintenance of that will be also eligible for the ATI. Right? Next is industrial parks. An undertaking which develops and operates or maintains and operates an industrial park. So any entity which is engaged in the development, operating or maintaining the industrial park is also eligible for the ATIA deduction. However, the undertaking has to enter into an agreement with again the central government. Are we clear? So that entity will also be eligible. Next is, if you look at power undertakings. Any undertaking which is set up in any part of India for the generation and distribution of the power before 31st March 2017 or starts transmission or distribution by laying a network of new transmission and distribution lines between this period, or undertakes substantial renovation and modernization of the existing network of transmission and distribution line. Meaning there's an increase in the these transponders which are there for the distribution and the transmission of the line. So these are the entities which are covered under ATIA deduction. Okay. Then if you look at it, as I said, in this ATIA you have and even entities which are undertaking which are owned by an Indian company which are set up for construction or revival of the power generating plant. So that is also included. Fine. So these are the businesses which are covered under ATIA. So developing, operating and maintaining infra facility, industrial parks, power generating or distribution unit, inland container depot. All of these are as the eligible business. What is the quantum of deduction over here? The quantum of deduction here is 100% of the profit and gains from the business for 10 consecutive assessment years commencing at any time out of the 15 years which are there in respect of certain businesses. So what they are saying is that the quantum of deduction is your 100% of the profits derived from this eligible business will be allowed as a deduction under ATIA. However, what is the eligible period? For how many years you can claim this deduction? 10 consecutive assessment years. So you have to take all the 10 years together. Out of the 15 assessment years, for all the eligible businesses except mentioned in point 2 below. So all the eligible businesses which are there other than which are mentioned in the point 2 below, you have to claim for the out of the 15 years in the 10 consecutive assessment year, you can claim the deduction. So you can select the first 15 years, you can select the last 15 years, that is fine. But once you select, then you have to go continuously. You cannot be saying that 1 year I will claim, another year I will not claim, another year I will claim, again I will not claim. So it has to be the 10 consecutive assessment year. And in case of the businesses which are in the nature of developing the infrastructure facility, which is basically a public facility like road, bridges, highway project, water supply project, irrigation project, there you can claim out of 10 years out of the 20 years. 10 years out of the 20 years. Are we clear? So if you look at it, here I have put it, eligible period is 10 out of 15 AYs. For road, highway project, water supply project, it is 10 AYs out of 20 AYs. Are we clear up till now? Any questions, any doubt? Yes, is this
मैम
yes?
15 AY है जब वो बिजनेस चालू करता है वो 15 ईयर्स के अंदर में एनी 10 ईयर्स ही कैन क्लेम राइट मैम
Correct. Yes.
ओके
Any other question? Yes. Is this clear? Okay.
यस मैम
Fine. So this is about the ATIA. Now please note that this is only available for all the eligible businesses which starts the development or operation and maintenance before 1/4/2017. After 1/4/2017, if you start, you will not be eligible for the ATIA deduction. Are we clear? So just write it over here. Available up to 1/4/2017, or you can write like this: available if business starts operation before 1/4/2007. Is this clear? Fine. Okay. Now, if you look at it, we will look at certain other provisions of the ATIA. Now, this particular point 1, eligible business to be considered as the only source of income. What does it say? It says for the purposes of computing the deduction under this section, the profit and gains of the eligible business shall be computed as if such eligible business were the only source of income of the assessee during the relevant previous year. Now, what does this imply basically? What does it mean that the eligible business is, let's say, the only business of the assessee for the purposes of claiming the deduction under ATIA? So, if you look at ATIA, subsection 5 starts with a notwithstanding clause. It starts with a notwithstanding clause. Let us have a look at it once. To understand in detail, let me open up the income tax website for you. It says, notwithstanding anything contained in any other provision of this act. Meaning this is overriding all other provision of the act. It's a notwithstanding clause, non-obstant clause. The profit and gains of an eligible business to which the provisions of subsection 1 apply shall, for the purposes of determining the quantum of deduction under this subsection for the assessment years, be computed as if the eligible business were the only source of income of the assessee. Now, let us understand this particular point. This particularly means that, let's say for example, if I have a loss in 1 year, okay, I am having a loss in one of the year. Next year, I am having profitability. Now, what will be my deduction under ATIA? That is the question. So, let's say for example, I have a loss from the non-eligible business, which is let's say 20 lakh. I have a profit from the eligible business, which is let's say 90 lakh. Now, what is my deduction under ATIA?
90 lakhs.
90 lakhs?
Because we have to compute as if it is only the business. So we should not consider the loss of the non-eligible business into it. So 90
Ye-
lakhs will be the deduction.
Yes. So, here in this case, let's say for example, if I have other income also, let's say I have 90 lakh loss, let's say loss from, 90 lakh profit from the eligible business, loss from the non-eligible business is 20 lakh, and let's say I have income from other sources as 25 lakh. So what will be my deduction under ATIA?
Still 90 lakhs.
Let us understand this. So I have profit from eligible business 90 lakh. Loss is let's say 20 lakh, and this is, so my deduction under ATIA will be 90 lakh, would be 70 lakh, or will it be, yeah. So what it will be? So one person has said that it will be 90 lakh. Yes? Or will it be 70 lakh? What are the other views? 90. Only this particular business income, other income is not allowed. Other only allow 90. Okay? 90. Everybody is of the same opinion that it should be 90 lakh. Now, first of all, the question which arises is that whether you should claim the set off of the non-eligible business loss against the business eligible business loss, or whether you should claim the ATIA deduction first. Are you getting it? So here the question which is arising is that should we claim first set off of loss or ATIA? Yes or no? This is our concern. This is our problem. That what should we do first? If you go as per the order of sections, 70 comes first. If you go as per the ATIA, it says that it has to be considered as only income. So what should I do first? So if I take my total income, which is PGBP, which comes to 70 lakh, right? Then the chapter 60 deduction, I will only restrict to 70 lakh. I can't claim 90 lakh. Or it should be 70 plus 25, which is how much? 95. So I can claim 90. Isn't it? So what should we do first? So that is where 80 IA5 comes into picture, which says, notwithstanding anything contained in any other provision of the Act, for the purpose of determining the quantum of deduction, the profits of the eligible business shall be computed as if the eligible business was the only source of income. Are we getting it? So here, what I will do is, if I take this ATIA 5, this is basically saying this particular point. What does it say? Notwithstanding anything, for the purposes of ATIA deduction, for the purposes of the ATIA deduction, compute on the basis that eligible business, that the eligible business was the only source of income. So in this particular case, ideally, my total income is coming to 90 minus 20 plus 25. Isn't it? This comes to how much? 95 lakh. Yes or no? But for the purposes of ATIA, for the purposes of ATIA, what I will do is, I will consider that it is only 90 lakh. For the purposes of ATIA, I will consider that this is only source of income, which is 90 lakh. And therefore, I will allow the entire deduction restricted to 90 lakh. So even though I am setting off the loss, even though I am setting off the loss, I will restrict it to the 90 lakh. Are we clear? So here what I will be doing is, deduction under ATIA will be my entire 90 lakh. Are we clear, students? Yes?
Ma'am, other
Yes.
income from other source is only 15 lakhs.
Only?
15 lakhs, not 25
Hmm.
lakhs, it is 15 lakhs. Then total income will be 85 lakhs,
Hmm.
right?
Then we'll restrict to 85 lakh.
Then it will be
Because
restricted.
obviously, yeah, I'll come to that point. So if, let's say, for example, my two other sources, let's say, yeah, I change it to, let's say, 15 lakh. Okay. So this becomes, okay, 85. Now for this purpose, I'm inviting your attention to the first section that we started with. What was it? Our section 80AB. Okay. What does 80AB says? If you read the 80AB, It says this section provides that for the purposes of calculation of deduction under Chapter 6A, under the heading C, deduction in respect of certain income. Basically, deductions in respect of income, it is talking about that. The income computed in accordance with the provisions of the Act before the deduction under Chapter 6A shall alone be regarded as income received by the assessee and which is included in his gross total income. Accordingly, the deduction specified in the aforesaid section will be calculated with reference to the net income as computed in regards to the provisions of the Act and not with reference to the gross amount of income. So what does ATAB tries to say is same thing. What ATIA 5 is trying to tell us, isn't it? So if you read the ATAB also, consider the income from the eligible businesses as the only income. Fine. However, now if you look at section 80, if you look at the section 80A which is there, what does it say? So let us look at that. So it says that the aggregate amount of deductions under this chapter shall not in any case exceed the GTI of the assessee. So what does ATA says? My ATA says the chapter 6A cannot exceed my GTI in any case. So in this particular case, it shall be restricted to 85 lakh. Is this clear? Yes?
Yes, ma'am.
Fine. So you have to read all the provisions in consonants. Fine. So my total income will be computed considering the losses under 70. And then I will allow the chapter 6A. But my chapter 6A deduction will be restricted to my gross total income. I cannot be exceeding that. Are we clear? Yes or no? Any doubt? Any question?
Yes, ma'am, clear.
Fine. So this is very, very important. In the examination, you can get this kind of adjustment. Okay. Now also I am inviting your attention to one of the Supreme Court judgment at this point in time, which is in the case of Reliance Energy Limited, where the question was same. Does the profit link deduction under Chapter 6A have to be restricted to income computed under the head PGBP? That was the question. So what did the Supreme Court said? For the purpose of calculating the profit link deduction under under any section of Chapter 6A, loss sustained in other divisions cannot be taken into account, as only profits from the eligible business have to be taken into account as if it was the only source of income. Profit and gains from eligible business cannot be reduced by the loss suffered in any other business owned by the assessee for the purpose of calculating the deduction under ATIA. The deduction under ATIA could not be limited to the income under the head PGBP by setting off the losses from the non-eligible business against the profit from the eligible business. So if you look at it, here also they have given the same example that the profit from eligible business is 90, loss is 20. So the income under that PGBP is 70, and here you have taken the 15 what you were asking, right? So my GTI becomes 85 lakh. So you have to assume that the deduction under ICAI is the only deduction under Chapter 6A. This is only assumed that in this you will assume that the profit from the eligible business is the only source of income. Right? The profit from the business is the only source of income of the assessee. So here my deduction under ICAI would not be restricted to 70 lakh. Right? Here I will be able to claim the entire 90 lakh. But as per ICAI, I will have to restrict to the GTI. Right? I will have to restrict to the GTI. Is it clear to everyone? This example, this particular point? Yes? Any questions, any doubt? You can make a note of this. Okay? Let us make a note of this particular Reliance case. Fine? Okay? Now, let us move further. Now, let us understand that what if there is a loss in the eligible business? Can it be set off against the non-eligible businesses? Yes.
Yes, ma'am.
Can we set off?
Yes.
Okay. So let us consider here as an example. Let us try looking at one of the example. Let's say my profit of the, or let's say my eligible business is there. Let us make a note here. Let's say I have two businesses. Eligible business and a non-eligible business. Okay. So first point here would be that I have a loss of 20 lakh in my eligible business. I have a profit of 70 lakh in my non-eligible business. Okay. So let's say my loss is 20 lakh and here the profit is 70 lakh. Now the question students arises in this case is that the profits are exempt. So will you be saying that the loss is also exempt? Or can you claim under 71?
Ma'am, we get deductions for the profits, for the income we earn, but not for the losses we occur. So
Correct.
I think 80 deduction will not be allowed here.
Like deduction will not be allowed, certainly. Here, the deduction is not going to be allowed because there is no ICAI applicable because there is no loss. Samyathan, here we have ICAI, but in this year we have incurred the loss. We have not earned the profit. Let's say my expenses were more than my income. Let us take a classic example here that let's say I had a profit. Let's say I had a profit of 100 lakh. But let's say my depreciation itself was 120 lakh, resulting in this loss of 20 lakh. Possible? So here, ICAI is not applicable. as no profits, right? But as per section 71 intra head set off, I can claim the loss from the eligible business against the non-eligible business. So this set off is permitted under 71. Fine. There is no prohibition in this particular case. Any questions? Any doubt? Fine. Yes or no?
Clear, ma'am.
No problem over here. Fine. Now, let us understand that what if I have, let's say, again two businesses, eligible, non-eligible. Fine. I have a loss of 120 lakh. Let's say now we are considering the data for 4 assessment year. Okay. Now, let's say for example, I have here the profit of 120 in the non-eligible business. Sorry, this is, why. Okay. Let's say this is 40. Let's say this is 100. And let's say this is 60. And this is the data for AY 22-23, 23-24. Or let's start from, okay, 21-22. Okay, 25-26. Fine. Now, in the first year, I had this loss from the eligible business. Okay. And in a non-eligible business, I had the profitability. Fine. Now, in the next year in the eligible business, I have a loss of, I have a profit of, let's say, 20. In the next year, sorry, this is appearing as 40. So in the first year, can I set off the losses against the non-eligible business?
Yes, ma'am.
Because here it's loss. Yes.
Yes, ma'am.
So I will set off this under 71. No problem. In the next year, what will be my deduction under ICAI?
20 lakhs.
Will it be 20 lakh?
Yes, ma'am. Why? Because we have set off the loss in the assessment year 22-23. So there won't be any carry forward of the losses there.
Read what ICAI 5 says again.
It says that we have to compute at if it is only the eligible business. So
Yes.
120 loss will be set off from the 20 lakhs loss for the next year profit.
Yes. Correct. So, what does our ICAI 5 says? If you look at it, it says notwithstanding anything, the profit and gains which are there, you have to consider that it is the only source of income. From the eligible business, whatever profits are there, this is the only source of income. So here, if you look at it, this 120 which is there, we will assume that this is not offset against the non-eligible business. Are we getting this point? So what we will do is, next year, we will set off 20. So here my deduction under ICAI for this year is 0. What is then remaining? 100 lakhs. Again, I will set off against this 60. What remains here again? Deduction is 0. Balance is my 40 lakh, which is still remaining, which I will offset against this. Are we getting this point, students? So yes, Samnathan, already set off is done against the non-eligible. Now the carry forward is 0. You are right. But you can't be using the provision in your favor, and when it is against you, you may say that no, I don't want to use it now in my favor, or I don't want to use this provision anymore. So when in this particular year, when there was only 1 year transaction, you were saying that, okay, I have set off the losses, but ICAI 5 is saying that notwithstanding anything, I will consider this as the only source of income. Fine. So it allowed you the set off of loss also in that year, plus it allowed you the deduction of 90 also. It didn't say that the deduction is 70. Now, when you have the brought forward losses, which you have already offset against the non-eligible business, now you can't say that no, I will not offset the brought forward losses against my eligible business, because ICAI is saying that it is the only source of income. ICAI 5 is telling you that this is we are creating a fiction. This is a fiction created by ICAI 5, which is telling you that compute the deduction under ICAI 5, under ICAI as if it's the only source of income, as if the income from eligible business is the only source of income. So that presumption has to be created for all the years. Even though under 70 you are offsetting, in this year also you are offsetting. Now connected to 1 second. In the year when you had the same year when you had the set off of losses and you had the profits under the eligible business, you were setting off the losses under 70, plus you were claiming the deduction considering that is the only source of income. Right? Now, when you have multi-year like income that you have, like you had the losses, you had the brought forward losses and you have the current year income. Now you can't say that it was not the only source of income. I will only offset under 70. There is no income this year also. Because you are considering this as an only source of income, even though you have offset under 70 this loss. But now you have to consider this as the only source of income for all the years. Under 22-23, this was considered as only source of income. So as per the fiction of ICAI, 120 was never set off. Even though under 70 you set it off for the purpose of your total income computation. But for the purposes of ICAI, deduction under ICAI, there was no income in 22-23 because there was a loss. And according to ICAI, this loss is not set off. So in 23-24, I am setting it off. Still it remains. In 24-25, I am again setting it off. Still it remains. Therefore, I am 25-26, I am again setting off the remaining. And 75 minus 40 is what I will be eligible for reduction under ICAI. Is this clear, students? Yes or no? Suppose AY 22-23 is my 8 year for ICAI, still it remains same for subsequent year. I didn't get your question, Jyoti. Samnyathan, already set off is done. You are right. But in the first question also, where we were doing the already set off there also, still you were claiming ICAI deduction because your deduction was more than your Because you didn't have any brought forward losses. See, the difference between the two questions, the first question that we did and this question is, first question me, you didn't have the losses from the eligible business. You had the loss from the non-eligible business. जो ये क्वेश्चन था इसमें भी तो आप सेट ऑफ कर ही रहे थे ना 70 में नॉन एलिजिबल बिजनेस का अगेंस्ट दी एलिजिबल बिजनेस राइट वी सेट ऑफ दिस 20 lakh isn't it against the eligible business yes or no but why I was allowing the deduction of 90 lakh is because it was the only source of income and the only source of income was profit. In this question, I have a loss from the eligible business itself. And I am considering it as the only source of income. Eligible business ही मेरा एक source of income है, ये मैं fiction से treat कर रही हूँ. This is a fiction I am creating. Now 120 is according to ATIA, not set off. Even under the non-eligible, you were setting it off. Under 70. But as per the fiction of ATIA, I have not set off. Correct? यहां भी तो हमने यही किया था भले हमने 20 सेट ऑफ कर लिया था 90 के सामने बट व्हाट वाज द फिक्शन सेइंग एटीआईए का that it is ignoring that if you are set off anything. So I was allowing you the deduction of entire 90 because मेरा profit था. अब मेरा loss है अब मेरा loss है eligible business से. So it has not been set off. That is what I am considering. Now whatever eligible business I will have in the future years, I am carrying it forward that loss as per the fiction of ATIE. Are we getting this, students? 23-24, how it will be taxed is taxation will remain the 40 plus 20 60. My GTI will here be 40 plus 20 60. I will not get the deduction under ATIA. Is this clear, Samnithan? Yes, students, is this clear?
So this means the carry forward and set off in further years, subsequent years is only for the purpose of this, considering that there was, because 120 lakhs was already set off in the first year. Now it would tantamount to double deduction if this 20 lakhs, 60 lakhs and 75 lakhs was again given deduction.
Correct, yes.
Is that true? Okay.
So ATIA is basically creating a fiction for me and this fiction will apply even in the case of losses, even in the case of profits. Clear? Yes, any question, any doubt? Yes or no?
Clear, ma'am.
Fine. So, 20, 40, 60 lakh will be taxed. Yes. 24, 25, 60 plus 100 GTI will be taxed. Yes, correct. 25, 26, 25 plus 60 will be taxed. No, not, see, Samnathan, 25, 26 May, you're right up till here. In this year, it will be 25 plus 60 minus ATIA. So my GTI will be 60. I hope this is clear, Samnathan. 25, 26, Samnathan, you are making mistake. You will allow the ATIA because the losses up to 40 lakh are set off. 25 lakh will be claimed. Yes, now is it clear to you? Yes or no? Any student has not understood? Please tell me. Should I explain once again?
In 25, 26, it would be 35 lakhs balance.
Yeah, 35, sorry. Samnathan, 40 plus 60 will, how 40? Where is 40 is the loss, Samnathan. 35 plus 60, yes. But you will also get the ATIA deduction of 35. You will tax 35, but you will also get the deduction under ATIA, na? In 25-26, Samnathan. Is this making sense? Yes or no?
Yes, ma'am.
Yes.
Understood,
Okay.
ma'am.
Yes. Samnathan, 40 will not be taxed in 25-26. How 40? It will be 60 which will get taxed now. Where is the 40? 40 is the loss. 40 is the brought forward loss, Samnathan, which I am setting it off against 75. So 35 remains. So I will claim the deduction of 35 under ATIA and that will become 0. And 60 is what my GTI will be. Is that clear? Let me repeat it once again for the benefit of all the students. I think there's some confusion still. So the first thing is that I have a profit from the eligible business. I may have a loss from the non-eligible business. Can this be set off under 70? Yes, this can be set off under 70. No problem. This is not like our 35 AD. This is not like our specified business where the profits from the losses from the specified business can only be offset against specified business. That restriction is there under 73A for the specified business. In case of Chapter 6A deduction, this is a Chapter 6A deduction available for the profit from eligible business. So here these are not the specified businesses, right, under 35 AD. 35 AD mein, if you remember, we had this restriction that losses from specified business can only be offset against profit from specified business. No restriction here for the profit from eligible business. Right? So losses from non-eligible business, I can set it off against the profits of my eligible business. No problem. Fine. Now, the loss from the non-eligible business, if I set off against the profit from eligible business, what will be my Chapter 6A deduction? So, ATIA 5, ATAB both tells me consider that the eligible business is the only source of income. So, even when I am setting off this non-eligible business loss of 20 against 90, which gives me the result of 70 lakh, my Chapter 6 deduction 70 lakh. It won't be 70 lakh. Why? Because I am considering my eligible business is the only source of income. So 90 lakh will be my Chapter 6A deduction. ATIA reduction will be 90 lakh. But what is my GTI? ATA says that the deductions can't exceed the GTI. I can't have negative income because of the Chapter 6A deduction. I can have loss, but I can't have negative income because of Chapter 6A deduction. My Chapter 6A deduction can't exceed my GTI. That's what ATA says. So I am restricting it to my total income. What is my total income? 90 minus 20 plus other sources 15, which is 85 lakh. So it is not that I am not eligible for 90 lakh. I am eligible for 90 lakh. I am restricting it to 85 lakh. Are we getting this? So here you can make a correction like this to avoid the confusion for you. So loss from non-eligible business, I can set off from profit from eligible business. Loss from eligible business, I can set off from the profit of non-eligible business. Intra set off is no restriction on that. So if I have a loss from eligible business and if I am setting it off against non-eligible business, fine, there is no income in this year. But in the next year, when I have profits from the eligible business, I will again apply ATIA 5. What does ATIA 5 says? Consider that this is your only source of income. So the ATIA 5 is telling me that this is the only source of income, and this I have to apply even in the year of loss, this particular fiction. This is my fiction which gets created, isn't it? So if this is, even if it is set off against the non-eligible income for the purpose of calculating the GTI, which is 0, but for the purposes of ATIA 5, I will consider that the losses are not set off, as this is only source of income, because I am presuming there is no other source of income. Are you getting it? So I will carry forward this for the purposes of ATIA 5. So I will carry forward this for purposes of ATIA. Are we getting? So 20 I will set off in 23, 24, 24, 25 I'll set off 60, and balance 40 I'll set off in 25, 26. So in 25, 26, 35 lakh is the income which remains, which will be eligible for deduction under ATIA 5, and my GTI will be 60. Is this clear now to everybody?
Yes, clear. And this is logical also. Otherwise, it would be double deduction if we don't do that.
Correct. Correct.
Clear, ma'am.
Yes. So you can't be setting off the losses as well as claim the deduction. Clear? Okay. Now, let us say, for example, let us understand that this profit of 75 includes the freight. This losses of 75 lakh includes the freight subsidy of, let's say, 10 lakh. Sorry. And includes, let's say, duty drawback of rupees 2 lakh. So what will happen? Will you be eligible to claim on the freight subsidy of 10 lakh the deduction under ATIA? So for this purpose, there are certain case laws that we will look into. Okay, there are certain case laws that we will look into. Let us have a look at the module. CIT versus Meghalaya Steel Limited Supreme Court ruling. Can transport subsidy, interest subsidy, power subsidy received from the government be treated as profits derived from business or undertaking to qualify for deduction under ATIA? This is about ATI, but it is equivalently applicable to ATIA section also. So it says there is a direct nexus between the profits of the undertaking and the reimbursement of the subsidy. So basically these subsidies are given to you by the government in order to reduce your expenditure, in order to reduce your cost. So all these transport subsidy, interest subsidy, power subsidy which the government gives you are nothing but the revenue receipts which are reimbursed to reduce your cost of manufacture or sale of product. So these subsidies qualify for deduction under ATIE and equivalently under ATIA also. So this will also be eligible for deduction under ATIA as per Meghalaya Steel Supreme Court as directly linked to the eligible business. Clear? So even if under the 75 lakh, this 10 lakh of freight subsidy is included, on that also you'll be eligible to claim the deduction under ATIA. Is this clear, students? Yes, any question, any doubt?
Clear, ma'am.
Clear? Now, what about the duty drawback? What is a duty drawback?
It is the duty paid first, then it is reimbursed to the company by the
Correct.
government.
Correct. Now, are they directly linked to the eligible business?
Yes.
So, see, duty drawback is kind of a rebate under the customs, right? It is a refund of the custom duty. So, when you import certain items, which you're going to export it, or on certain goods which are there, they allow you to pay the custom duty and collect the refund back. Right? So it is a duty drawback scheme. So in the Liberty Orkiv case, the Supreme Court noted that this duty drawback are incentives which are basically given under the Customs Act. Right? So these incentives are not the profits derived from the eligible business. They are the ancillary profits of the undertaking. They are not directly linked to the cost like your freight subsidy. Because when you get the subsidies, you directly reduce it from the cost of your expenses or whatever expenses you are incurring. But these duty drawbacks are not the direct income. These cannot be credited against the cost of manufacture or goods debited in the P&L. So these are not profits derived from the undertaking from manufacturing. And therefore, these will not be eligible for the deduction of ATIA. Are we clear? Yes? Is this clear? Let's write it over here. Is this clear, students? Yes or no?
Clear, ma'am.
Okay. Let us look at some other cases also over here. Can unabsorbed depreciation of a business of an industrial undertaking eligible for deduction under ATIA for set off against the income of another non-eligible business of the SEC? So, unabsorbed depreciation is basically a loss of the eligible business. Can it be set off against the non-eligible business? What is the answer to that? Yes. Can you set off? Yes or no? We just now discussed. Yes, students, faster. Faster, please. What is the answer? Can you claim the unabsorbed depreciation? Yes, Samnathan, we can, right? So, the loss, this is what we understood, right? That the loss of the eligible business can be set off against the non-eligible business, right? So, what does the Karnataka High Court say over here? Same thing. that ATIA 5 cannot override the provisions of 71. The deeming provision of the ATIA 5 are only in respect of ATIA deduction. It cannot say that you cannot set off the loss against the non-eligible business while computing the total income. So if the assessee has incurred the loss, ATIA 5 is saying that, okay, we will not allow you the deduction because this is your only source of income. But when it says that we are deeming that this is only source of income, that doesn't mean you cannot set off the loss for computing total income against the non-eligible business under 70. Because there is no profit in that year, ATIA doesn't become applicable. If the ATIA itself doesn't become applicable, you can claim the set off under 70. Yes. So the assessee is entitled to the benefit of loss. But yes, once you have claimed the set off of the loss of eligible business against the non-eligible income, in the next year, when you have the income, then you can't claim again the deduction because of the fiction of ATIA 5. Yes or no? So first you have to deduct those losses brought forward, and then if at all income is left, you will claim the deduction. Is this clear, students? Yes or no?
Yes, clear.
Clearer? Okay. Next is the increase in GTI consequent to disallowance under 40A1A eligible for profit link deduction? Now let us understand this. So let us say, for example, here let us say the 75 includes the expenses in relation to consultancy fee of rupees 1 lakh on which TDS is not deducted under section 40A, under section 194J. So if TDS is not deducted under 194J, what will happen?
Disallow
How much will be the disallowance?
30%.
30%, right? So if I take this 75 lakh now, okay? So or rather, I will not consider your loss for the time being. Okay. Here there will be disallowance under 40A1A. How much is the disallowance? 30,000.
30%. Yes.
Correct? This becomes 1 lakh. And my non-eligible business is how much? 60. Correct? Now for the purpose of deduction under ATIA. Yes? How will I calculate the deduction under ATIA? 70 lakh minus how much is it? Sorry, this is not 30,000. This is 30, not 30 lakh. This is 7.03 lakh. Okay. So 70 lakh minus 40 lakh was my brought forward loss, right? Because of the fiction. Yes or no? Plus, here I will what? Remove it what? I will consider FRET subsidy of 10 lakh. So I will not remove that. But I will remove this duty drawback of 2 lakh. Right? I will remove the duty drawback of 2 lakh. Yes or no?
Yes.
Right? So this 2 lakh duty drawback. Because this is not eligible. Now, tell me students over here. Okay, this is 75 lakh we have considered, not 70. 1 second. $75 lakh 30,000. Okay, so this is my 75 lakh. Now, with respect to this disallowance of 30,000, will this also be eligible for deduction under section 80 IA? That is the question. So in this context, what is the Bombay High Court ruling and the CBDT circular says? The assessee is entitled to claim the deduction under 80IB in respect of the enhanced GTI as a consequence of disallowance of expenditure under 40A1A. Because actually I have incurred that expenditure, but you are increasing my disallowance because of non-deduction of TDS. You are disallowing me that expenditure, but actually I have incurred that expenditure. I have incurred it. It's not that I have not incurred that expenditure. So if you're adding up my profit because of some non-compliance, you should give me the deduction, because the deduction is to incentivize the business. So the CBDT, through its circular of 2016, mentioned that if the expenditure is disallowed in relation to this business activity, the Chapter 6A deduction will be allowed if the disallowances are either made under 32, 40A1A, 40A3, 43B, and any other specific disallowances relating to the business activity because of which there is enhancement of the profits of the eligible business. Are we clear? So this is going to be eligible for deduction under ATI. So here I will add up this 30,000 because this is eligible. Are we clear, students? Yes or no? $32, 48.3 for the cash disallowance, 43B if you do not make the payment before the due date of return of income, 40A1A or any disallowances under PGBP. Resulting in enhancement of income from eligible business. Deduction allowed. Are we clear? Yes, even if the expense is disallowed, Jyoti, by the AO in the assessment, the AO will allow reduction under ATIA because he will be bound by the CBDT circular. So the revenue is bound by the circular. Clear? Yes or no? Any question, any doubt? Fine? Yes, students?
The 2 lakh of this duty drawback, we have taken it as deduction under section 80 IA. It is eligible
No,
under
we have
section 80.
removed. I have removed from the deduction because this is not
Okay, okay.
eligible. I have
Okay,
removed
I
from the profitability. Yeah.
Right, I thought is okay.
Got it? Okay.
Yes, got it.
Okay. The next one is a little simpler case only, which is basically asking if the trial production has commenced. Like, generally they do some trial products before they commence the actual production. So, from when will you start that 10-year period, 15-year period? From when will you start that? From the year of commencing the trial production or from the actual production? And will it make any difference if from the trial product some sale was made? So the Delhi High Court noted that if the trial production has started, let's say in the month of March, and the commercial production began in April. So with the trial production, the intention was to just see the quality, right? The manufacturing for the purpose of making the commercial production had not started. It will only start when the actual production starts. When the final product is okay, it is of adequate quality and it is ready to sell in the market. It is fit for consumption. Even if when the assessee makes some sale to test the quality of the product from the trial production, if he makes the sale, now whether in that case, when will the deduction start? So in that case, if he has made the sale from the trial production, that means it was fit for consumption. If there is no sale made from the trial production, then the deduction will start from the actual production. So if the sale has started from the trial production, they are saying that the product is therefore means fit for consumption because the producer manufacturer thinks that this is all right to be sold in the market. And therefore, it will start from the year of the trial production. If the sale is not made, it will start from the year of the actual production, which is fair, right? The next case is basically in relation to this ATIA deduction only. What it says is that for the purpose of claiming ATIA, the company should have an agreement with the government, right? Now, can an agreement entered into by a firm with a state government and work done in pursuance thereof survive upon its conversion into a company? So the firm has entered into an agreement, not a company. If you see, ATIA is available to a company. But now the firm has got converted into a company, and will it be considered as a deduction under ATIA? So what the Supreme Court noted is that it says that the enterprise is to be owned by a company registered in India. And they should have an agreement with the government or the local authority for developing, operating and maintaining of the infrastructure facility. Now it looked into the memorandum of association of the company whose main object was to acquire a firm as a going concern. So means the firm translated into a company with all the assets and the liability, and the firm ceased to exist. And therefore the Supreme Court said that the company is qualified for the deduction under ATIA even if the agreement was entered when it was not a company, but because it has taken over this agreement, it has taken over by succession after the conversion of the partnership firm. So therefore, there is no problem. It can claim the deduction under ATIA. Clear? Any question, any doubt? Yes or no? Fine. The last case is, can the assessee who has not claimed the ATIE in the initial years can start claiming from the mid of the years? Like whether it can, if it has not claimed at the start of its business, can it claim later on? Yes, it can. ATIE, ATIB doesn't say that it has to be claimed at the start of the business itself. All it says is within 10 out of 15 or 10 out of 20 years. Now it can be any years. So for the remaining period also it can claim, and this is what has been upheld by the Delhi High Court also. Clear? Any questions, any doubt? Any questions? Yes, is this clear?
Clear.
Fine. Now, let us look at the balance of the provisions, what are there. Okay. So now it says this, where housing or other activities are integral part of the highway project. I told you, like, even for the highway project, if there are any housing built on that highway project which are integral part of the highway project, they are also eligible to be claimed as deduction under ICAI. But there are certain conditions that the profits from that highway project, this is only for specifically the highway project, the profits should be transferred to a special reserve account. If you remember, the same condition was there under 33AB, 33ABA. Here also it is the same. And these profits then should be utilized for the highway project only. If at all they are withdrawn, right? These same conditions are there under 33AB also. Secondly, there has to be the audit of accounts. For all the ICAI deductions, the deduction shall be allowed only if the accounts of the undertaking are audited by a chartered accountant and the report is furnished by the due date under under the 44AB, which is 1 month prior to the due date of return of income, right? Because if you are claiming deduction, the government has the right to know whether you have correctly computed or not. Yes, Samyathan, only the company is eligible for ICAI. That's what we discussed also, isn't it? So if you see the chart that we drew over here, let me open it again. So here I clearly said that it should be owned by an Indian company. Clear? Then it says transfer of goods or services between the eligible business and other business. So if, let's say, for example, any kind of goods or services are provided by the eligible business to a non-eligible business, right? Or from a non-eligible business to an eligible business, that has to be at the market value. That has to be at the market value. And if the transaction value is more than 20 crores, it has to be at the arm's length price, right? So let's say, for example, if this is the eligible business, this is the non-eligible business, right? So if you transfer the goods from the eligible business to a non-eligible business, or from the non-eligible business to the eligible business, this has to be at the market value. Because otherwise what happened? Let's say, for example, if my profit from the eligible business is, let's say, 100, and let's say the profit of non-eligible business is 500. Now, non-eligible business doesn't get any deduction under ICAI. So obviously this will be, let's say, taxed at 30%. Right? Here I'm letting all the deduction under ICAI. So here obviously there is no tax. So what I will try to do is I will claim here, let's say, deduction of 400 by purchasing the goods from the eligible business, right? Here I will book a sale of 400, right? Because here, even if I inflate the profit, I will be eligible to claim the deduction. And here I will be reducing my profits to 100. So I will try to move my profits from the non-eligible business to an eligible business. Because in eligible business, I can claim deduction. In non-eligible business, I will claim the expense to reduce my profitability. So to prevent this, what they say is that this has to be at the market value. And if it is not at the market value, you will not get the deduction to the extent of difference between the two. So let's say if my market value was only 200, so your deduction will be 100 plus only 200, not 400. Clear? And if the transaction value here is greater than rupees 20 crores, this will be called as a specified domestic transaction on which TP applies, and therefore this will be at the arm's length price. Clear? Instead of market value, then it will be at the arm's length price. Yes, it will be a specified domestic transaction. Are we clear, students? Yes or no?
Yes, what would be arm's length price?
That you will learn in the transfer pricing class.
Right.
That we will see it in the TP classes, how the ALP is determined, because there are the methodology to determine the ALP. Fine?
Right.
Okay, any question? So even ATA provides for this. So if you look at the ATA, it says the transfer price of goods and services between the undertaking of the eligible business and between the other business of the assessee shall be as per the market value. What is market value? The price in the open market. So ATA also tells you this particular same thing. Are we clear? Last point under ATIA before we go on to the break. ATAC requires you to furnish the return of income on or before the due date under 139(1). So if you claim these deductions under ATIA, ATIB, ATIAC, ATIBA, IE, ATJJAA, ATLA, ATM, QQB, RRB, you can only claim that if you file the return of income on time before the due date of 139(1). If you file the belated return, you will lose the exemption, or so you will lose the deduction under this particular sections. Are we clear? Any questions, any doubt? Yes? So let's take a break of 10 minutes and then we get back. Okay. So we are done with the first one, which is ATIA. Next is similar one, ATIAB. Okay. So we have done ATIA. Now we are doing ATIAB, which is very, very similar to. So the concepts will remain the same for all of these deductions. Remember that. So the concepts are not going to change, only the applicability is going to change. Now this is in respect of 100% of profit and gains derived by an undertaking from any business of developing an SEZ. ATIA was with respect to developing, operating and maintaining the infrastructure, which included these highways, roads, power generating units, power transmission units, your development of ports, inland container depots, and your industrial parks. This is development of the SEZ, right? What is the quantum of deduction? 100% of profit derived. Again here 100%, right? Again here the deduction is available to an assessee being the developer of the SEZ. Developer is a person who or a state government has been granted a letter of approval by the central government. So either that person or any state government which has been granted the letter of approval from the central government to develop the SEZ, because SEZ development is a very national importance project, right? So it has to be approved by the central government. Again, your option to choose 10 consecutive AYs out of 15 AYs with respect to the claiming of the deduction. So same as ATIA itself. Okay. Now here what they are additionally saying is that deduction will also be eligible to the transferee who has acquired the business of the transferor, and there is a transfer of the operation and maintenance of SEZ to another developer. So the other developer will be allowed the deduction for the remaining period. Then there is a CBDT circular which is important, which is saying that income from the letting out of the premises in the SEZ, whether that will be classified as business income or house property. So do you recollect that under 28 there has been a specific carve out? What was that carve out? Can anybody point out that? Yes. Yes, students, what is the carve out? Income from letting out of the property. Under which head it is taxable? House property, Jyoti? Yes. But what if my business is to lease out the spaces, develop spaces in SEZ? If it is my business, under what head it will be taxable? If I am in the business of letting out, under which head I will be taxable? Yes, students, you have forgotten PGBP. Whether PGBP or IFHP.
IFHP.
IFHP, right? Because there is a specific explanation now. Under section 28, if you look at it, if you don't recollect now, let me make you recollect. Under 28, there was a specific explanation which clearly provided that the income from the letting out of the residential house property will not be chargeable under the business income. So it is hereby clarified, income from letting out of the residential house shall not be chargeable under the PGBP but under the IFHP. But this is only in respect of the residential house property. So where I am into the business of leasing of residential house property, even then it will be IFHP and not PGBP. But what if I am into the business of leasing the commercial property? Then in that case, there was one ruling which is applicable. Which is that ruling? Which is that ruling? Which was that ruling? Yes, past. Chennai Properties case, student. Yes, Chennai Properties. Yes, Jyoti, very good. So Chennai Properties case, there it was observed from the memorandum of association of the company that the objective of the company was to lease out the property. The objective of the company was to get into the business of leasing out of the property. So this particular explanation overrules the Chennai property case only in respect of residential house property. If my business is in the leasing of commercial house property, the Chennai property case holds good. Right? And therefore, it will be chargeable under the head PGBP and not IFOS. Because this explanation only carves out the residential house property. So, where I am into the business of letting out the SEZ premises, it will be chargeable under the head PGBP and not under the head IFHP. That's what the CBDT circular also points out. Income from leasing of developed space along with amenities in SEZ is PGBP and not IFHP. Are we clear, students? Yes, any question, any doubt? Okay, let's move to the next deduction. First, we'll complete the ATIB. Deduction in respect of profit and gains from certain undertaking. So, which are the undertaking? Business of processing, preservation, packaging of fruits, vegetables, meat and meat products, poultry, marine, dairy products. Or from the integrated business of handling, storage and transportation of food grains, right? So ATIB is applicable for processing, preservation, packaging of fruits, veggies, meat, dairy, poultry. So basically food items. If I am into the processing, packaging and preservation, again this is to incentivize the businesses to get into this kind of business so as to reduce the rates for these food products. So that's the reason why government is granting them this deduction of the 100% of the profit. So the businesses which are into the processing or preservation and packaging of these vegetables, fruits, meat, poultry, dairy, marine products, right? Or into the handling, storage and transportation, then in that particular case, they are eligible for the 100% of the profit for the business for 5 assessment years, beginning with the initial assessment year in which you commence the business. So here, unlike ATIA and ATIAB, here you can't choose any of the 10 years. Here it is basically for the first 5 years, 100% of the profits will be exempted or the reduction will be allowed. For the next 5 years, 25% deduction will be given of the profits and 30% in the case of companies. So total period is the 10 years, but it is from the commencement, unlike the ATIA and ATIAB, where you could choose the 10 years from the 15 years. If you remember, we did the Delhi High Court judgment also, which said that it need not be from the first year of operation. But for ATIB, you need to do it for the first 5 years, 100% from the commencement. And then in the next 5 years, it is 25% for others and 30% for companies. Is it clear? The distinction is clear to you? Fine. Next is ATIBA. ATIBA is in respect of the profit and gains from the housing projects or rental housing project. So ATIBA is basically to give the incentive to the businesses to develop the affordable housing. Right? So this is only for the businesses who are into the development of the housing. However, the project have to be approved between the 1st June 16 and 31st March 2022. The housing project. This is not applicable after that. And the project has been completed by the builder within 5 years from the date of approval when it receives. Are we clear? So the carpet area is not exceeding 3% of the aggregate carpet area. Oh, sorry, carpet area of the commercial establishment, meaning it should be for the housing project. It should not be a commercial establishment. So the builder should not, in order to claim this deduction under this particular section, they should not, develop only, let's say 10 houses and the rest of the commercial premise. Right? They may say that this is housing project only, but there may be only 10 houses and the rest is commercial. So that shouldn't be the case. So they are saying that the restriction is there on the development of commercial. They can keep, some space for the shops, stores in that building, but that should not exceed 3% of the total carpet area of the project. So the carpet area of the shops and commercial establishments should not exceed 3% of the total carpet area. And where a residential unit is in that housing project is allotted to one individual, then again that individual or his spouse or his children should not be allotted any other space. So one particular unit should be allotted to the one particular individual only. Are we clear? So these are some of the conditions which the person has to fulfill. And this is only applicable if the project was approved before 2022 and was completed within the 5 years of that. Yes or no? Any clear? Any doubt, any question? Then they say there are certain conditions relating to the size of plot of land, residential units. You don't need to remember all of this. Like this is, if the project is located in this metro cities, then the size of the plot, size on plot of land on which project is located should not be less than 1,000 or 2,000. The carpet area of the residential unit which is there should not be more than 30 square meter. The percentage of floor area to the ratio to be utilized by the project. So again, these are certain conditions which are given. So these conditions you don't need to remember, but just know that these are there. And in case of the basically project approved after 2019 and before 2022, the housing project cost, the stamp duty value of that should not exceed 45 lakhs. So if you fulfill all of these conditions, then 100% of the profit will be exempted under this particular section. And if you look at it, what is the period of exemption, which is what they have given over here? 100% of the profits are allowed as a deduction. But the eligible period is not applicable. You can claim in any of the years. It is not that, within the first 5 years, first 10 years, out of 15 years, eligible period is not at all applicable over here. So I've written over here, it is not applicable. Clear? Secondly, if you have a look at it, it says that if the project is not completed within the 5-year window, right? If the project is not completed within the 5-year window from the date of approval, the deduction that you have claimed will now be deemed to be the income. Okay. So this is what is section 80 IBA. IA was with respect to infra facility. IAB was with respect to developing the SEZ. IB was with respect to the food products. And IBA is with respect to the housing projects. Clear? Next is 80IE. This is in respect of the undertaking in northeastern states. To manufacture any article, to undertake substantial expansion to manufacture or produce, or to carry any eligible business. So eligible businesses basically setting up the hotel, any kind of adventure sports there, medical and health services, old age home, vocational training institute, IT related training centers, manufacturing of IT hardware, biotechnology. If you get into any of this business, to basically give the incentive to business to set up the businesses in these northeastern states for the development of those states, this 80IE section is there. So here again, if you look at this 80IE section, what is the deduction? 100% of profits. Again here it is 10 years from the commencement. So here, unlike again 80IE, it says it has to be from the 10 years of the commencement of the business. So you have to claim it from the initial assessment year. Are we clear, students? Any question, any doubt? Yes? The last one is ATIAC. Now, this is the deduction which is eligible or which is given to a startup. ATIAC is given to a startup. What does it say? So basically, in order to provide the incentives to the startup, this particular deduction is given. Again here, 100% of the profits of the undertaking which are derived by an eligible startup from doing the eligible business are given to them. Okay, so 100% of the profit, and this is allowed for any 3 years out of the 10 years from which the business is incorporated. So in any 3 years, you can claim this startup exemption. Now, what are the eligible startup? The eligible startup is basically including a company or the LLP. Both are eligible. A company or LLP which is incorporated between 1/4/2016 and 31st March 2025. 1/4/2016 and 31st March 2025 if you are a company or an LLP. Right? Both are eligible. Remember this. For ATIA, we had only company as the eligible. Here you have company as well as LLP. Partnership is not included. Company or LLP whose turnover is less than equal to 100 crores in the year in which deduction is claimed and holds a certificate of startup and is engaged into the business of innovation, development, improvement of product or process or service, or a scalable business model with a high potential of employment generation or wealth. And it is not formed by splitting up or reconstruction of existing business. It should be a new business. Right? It should not be some, buyout of an existing business. Are we clear? Then it is not formed by the transfer to a new business of old plant and machinery, except if it is an imported plant and machinery or the value of the plant and machinery which is taken, which is a second-hand plant and machinery, is less than 20% of the total value of plant and machinery. If you remember, the same condition exists in the other sections also in PGBP, in 35 AD and all of that. Do you recollect? Then in that particular case, you can claim the deduction of the ATIAC. Yes, any questions, any doubt? Yes or no? Any doubt with respect to this ATIA deductions? Yes? Fine? Okay, yes. So this completes your ATIA deduction entirely, or income related deductions in respect of these specific undertaking. Now there is one more deduction, or rather the exemption you may call, deduction you may call, which is under 10AA. Okay, 10AA deduction. Let us look at it. Deduction under 10AA. Now here again there is deduction of the profit and gains which are derived by an assessee being an entrepreneur from the export of articles or thing or providing any services from an SEZ, which is basically a unit in SEZ. Okay, so this particular deduction under 10AA, who is the eligible assessee? A unit in the SEZ, which is engaged in the manufacturing or production or provision of services and which is basically exporting the goods and services. But what is the condition over here? What is the condition over here? The condition is that the export proceeds are to be realized within 6 months. Right? So, this 10AA is available to a unit of SEZ. 80IB was available to the developer of SEZ. Are you getting this particular point? So, if you look at this, one second, I think there's some problem with this app. Yeah. If you look at this, what did I tell you? 80IAB was to the developer of SEZ, whereas 10AA is for the unit which is operating in SEZ and manufacturing and exporting the goods outside India. Are we clear? So, this is the export of goods or services from the SEZ. And the deduction is available to the manufacturer who exports the goods. Yes, and this is basically available till 2020-21 assessment year. So, manufacture or production of goods has to begin before that. Right? So, if the SEZ unit has received the approval and begins the manufacture of goods or services before 2020-21, then in that particular case only it can claim the deduction. So, you can write it over here. Commences manufacturing before 31st March 2021. Clear? This deduction is available only when you bring the export proceeds within the period of 6 months from the end of the previous year. Now, what is the deduction over here? 100% of the profits for the first 5 years. For the next 5 years, 50% of the profits. And after the 10 assessment year, 50%, but subject to the amount credited to the special account, which has to be again utilized within the 3 assessment years for the plant and machinery. It has not to be utilized for distributing dividends or for creating any asset outside India or for making remittance outside India. Right? So here what they say is that 100% of the profit will be allowed for a period of 5 years beginning the assessment year in which you commence the manufacturing. You can't select any 5 years. 50% for next 5 years. Then another 5 years, 50% subject to that you transfer the amount to the special reserve account. Are we clear? So if you have commenced the manufacturing in 2010 for 5 years, 100%, for next 5 years, 50%, and in the last 5 years, 50% subject to you transfer the amount to the special reserve account, which has only to be used within the 3 years for the purpose of acquiring the plant and machinery. It should not be acquired, should not be used for distribution of dividends, for remittance outside India, or for creation of any asset outside India. In case you misutilize or you do not utilize within the 3 years period, then the deduction which you have been given or the amount which is not so utilized or the amount that you have misutilized shall be deemed to be the profits. Are we clear? Now here, what is the profit of the SEZ unit? How will you calculate the deduction under 10AA? So deduction under 10AA will be here profits of the unit in the SEZ. Okay. So here what it says, computation of profit and gains from the export of the business. So what is the deduction? The profits derived from the export business. What is the profit? Profits of the unit in SEZ into the export turnover divided by the total turnover. And in the export turnover, what will be my export turnover? So the export turnover which will be there will be basically my foreign exchange. The consideration that I have received in foreign exchange within the 6 months from the end of the previous year. It will not include any freight, any telecommunication charges, any insurance, or any other charges for rendering the services outside India. In the turnover, you will not include any freight, insurance, telecom charges. So if you are excluding from the numerator, you have to also exclude from the total turnover in the denominator. Are we clear? Any question, any doubt? Yes or no? Yes, any question? Is this clear?
We are excluding this freight, insurance, telecommunication charges from the export turnover.
As well as the total turnover. That's what the CBDT says, that if you exclude from the numerator, you also exclude from the denominator.
Okay, right.
Fine. Any other question? Okay. So this is what 10AA is. Now here also you are mandatorily required to file the return of income before the due date under 139(1), and you are also required to submit the audit report under 44AB. So not under 44AB, before the due date under 44AB. Plus, here if you are transferring the goods or services from the eligible unit or 10AA unit to non-eligible unit, it has to be at the fair market value. Same thing what we had it for the ICAI deductions. Again, if the transaction value is more than 20 crores, then it will be classified as a specified domestic transaction where the transfer pricing becomes applicable, and in that particular case, it has to be at the what price?
Transfer price,
Arm's length price. It has to be at the
arm's
arm's
length.
length price, right? Secondly, in case there has been the amalgamation of company, in case the company amalgamates, which was claiming the 10AA deduction, the amalgamated company will be eligible to claim for the remaining period. Any questions, any doubt so far? Fine? Yes? Any question? Once you have claimed the 10AA, you will not be able to claim on the same profits under ATIA or ATIB. Okay? Yes or no? Fine?
Yes.
Okay. Shall we solve one question? Yes, let's solve a question from the module itself. ABC Limited furnishes you the following information for the year ended 31st March 2025. Total turnover of Unit A located in SEZ is 120. Profit of the business of Unit A is 45. Export turnover is 60, which is in convertible foreign exchange. Turnover of Unit B located in domestic tariff area is 225, and profit of the business of Unit B is 25. You are required to compute the deduction. Yes, start computing and let me know the answer.
22.5 lakhs.
22.5. Jyoti, you've got 11.25. What about others?
Okay, we have to take 50% of 22.5. Yeah, that comes to 11.25.
11.25. Yes. What about others? Yes. I've not got the answers. 11.25, Samyatan. Okay. One second. I think my system has got hang. Let me show you the answer. Give me a minute. Yeah. So here, if you look at it, this is, we are looking at in terms of the which year? 25-26. And it has commenced the operation in the year 1920. Right? So 5 years have already lapsed. So we are not eligible for 100% deduction. This is the 6th year from 24-25. It's the 6th year. 6th year, 7th year this is. So it will be next 5 years, right? So 50% of the profit derived is eligible for deduction under 10AA. Correct? So as per 10AA, what is the eligible deduction on the profit derived from the unit in SEZ? Profit of the business of unit. Now, what is the profit derived of the unit? 45 lakh, right? Into the export turnover, what is my export turnover? 60,
60
which
lakhs.
is received in the foreign exchange within the 6 months. What is my total turnover? 120. So, divide by 120, it comes to 11.25 lakh after applying the 50% profit. Are we clear? So, this is how you are required to consider. Now, here if I introduce certain adjustment, right? Here if I introduce one particular adjustment that the export turnover includes the freight charges of, let's say, what is the year amount in lakhs, right? Yeah. So let's say the export turnover includes the freight charges of 10 lakh rupees. What would you do?
Exclude that.
Exclude it, right? So you will only exclude it from the numerator. The answer is no. You have to
From numerator,
exclude it from
yes.
the denominator. If it says it includes the insurance, exclude it from the numerator as well as the denominator of the total term. Are we clear about this, students? Yes or no? Any question, any doubt? Okay? Yes? Is this clear to everybody? 10AA is also easy for everyone. Any questions? Anything that anyone has not understood so far before we move on to the cases? These kind of questions can be asked in the examination, yeah? Okay. Let us look at the few cases which are pertaining to 10AA. Let's see what are those. Insurance, yes, will be excluded. Okay. So, this case is about, is deduction available under 10AA in respect of foreign exchange gains solely relating to the export business of the assessee? This is a very recent case in the case of Cognizant Technology. So, what here question was that whether the deduction is available on the foreign exchange gain which is relating to the export business. So, when you realize the foreign currency, the income in foreign currency, there can be foreign exchange gain or loss. So what the Supreme Court answer is that for claiming the deduction under 10AA, 10AA is on the export of the goods or services. Now, whatever exchange gain or loss happen, that is a consequence of the export business. It is not in the hands of assessee. So, this exchange gain or loss is solely relatable to the export business. And therefore, if there is a gain, that will also qualify for deduction under 10AA. Yes? So you can just make a note of this over here. Foreign exchange gain eligible for 10AA as per cognizant. Supreme Court. Fine. If no export, no foreign exchange gain or loss. Yes. Next is, can the expenditure incurred in foreign exchange for provision of technical services outside India, which is deductible for computing the export turnover, will also be excluded from the total turnover. So if you remember, I told you that from the export turnover, you don't have to only include the freight insurance, but you have to also include any charges in foreign exchange, right, which are incurred to provide the service. So once you exclude it from the export turnover, do you have to also exclude from the total turnover? So expenses incurred in the foreign exchange for providing the technical services outside India are to be excluded not only from the export turnover. If you exclude it from the numerator, you have to also exclude it from the denominator. Otherwise, the result will not be consistent. So if you exclude something from numerator, you have to obviously exclude from the denominator. Clear, students? Fine. The last deductions now we will move towards is ATQQB, ATRRB. Let us have a look into those deductions now. Why is it not showing? Yes. ATQQB. Deduction in respect of royalty income of the author. Right? So, what is ATQQB providing as a deduction is, it is providing the deduction for the royalties income. Okay, this is providing the deduction for the royalty income, and this is available only to a resident individual. This is to an individual resident in India. A deduction of maximum of 3 lakh. So author of the books, when they receive the income in the nature of royalty, right, they will be entitled to the deduction in respect of the income from royalty, or rupees 3 lakh, whichever is less. Right? So this is a very, very simple deduction. This is only in respect of the income from royalty. Clear? Any questions, any doubt with respect to this? Very simple. And this is only available to a person who is resident in India. If the royalties are earned from outside India, the income has to be repatriated within the 6 months period. So same like 10AA. So where the assessee earns any royalty from outside India, he should bring the income within India, the foreign exchange, within a period of 6 months. Same condition over here. And this is only applicable for the purposes of the royalty from the books. This is not applicable in respect of royalty income from brochure, commentaries, diaries, guides, journal, newspaper, magazine, any pamphlets, textbook for schools. These are not eligible. So, Samyathan, now under FEMA also it is 6 months. Right? So, under FEMA, you have to bring the proceed back within the period of same time limit which is there. Okay, so it is not that here you are allowing 9 months under FEMA and under the income tax it is 6 months. So basically what they are trying to say is earlier it used to be like a 9-month period, but even then what they are trying to say is that here you have to bring back the money within 6 months for the purpose of this. For the purpose of getting these deduction. So even though FEMA was allowing the export proceeds to be repatriated within the period of 9 months, but it is saying that for the income tax purposes, it has still considered as 6 months. So that is a discrepancy which exists. I agree. Clear? Okay. But a very good point to be noted, Samnithan. Fine. So this is the deduction under 80QQB. Any question with respect to this? Okay, fine. Now, here one more point before we move ahead is that the amount of income, royalty income should not exceed 15% of the value of the book sold. Because it shouldn't be the case that I am taking, instead of royalty income, I am taking the sale value of the books as deduction. So royalty maximum should be 15% of the value of books sold. So let us look at one question here. Mr. Akash earned royalty of 288 from a foreign country for a book authored by him, being a work of literary nature. Rate of royalties is 18%. Expenditure incurred by him for earning this royalty was 40,000. The amount remitted is 2,30,000. Remaining amount was not remitted until 31st March 26. Compute the income. Yes. How will you compute? Yes, students, faster. What is the deduction?
Amount received is 2,30,000 by 30th September. So that would be the amount.
Yes. So that will be the amount, that is correct. What about the expenses? Yes, correct. Samnathan, yes. Yes, Jyoti, correct. So here, how will you calculate is, see, 288 is my income, right, from the royalty. But as you may remember, I told you that up to 15% is what is allowed as deduction. The royalty should not exceed 15% of the sale value. So here it is 18%. So 288 into 15 divided by 18. If this is 18%, you will have to find out what is 15%. So royalty is 2,40,000, which is the deduction is 2,40,000, which I will allow. However, what I have received here is only 230 till 30th September, which is within 6 months. So the deduction will be restricted to 230. However, here I will also give the deduction of expense because the deduction is allowed for the income, not for the receipts of royalty. Income means receipts minus expenses. So the expenses will be allowed and whatever balance income is there, that will be eligible for deduction under ATQQ. Right? Under ATIA, ATIB also you do the same thing. It is the profits that you allow as deduction and not the receipts. Yes or no? So you will claim the deduction and you will allow a deduction of expenses, and then the income which is there, which is basically the net income, is allowed as deduction under ATQQ. Fine? Yes or no? Okay.
Yes.
Then is deduction in respect of royalty on patents. The ATQQB is royalty on authorship. ATRRB is royalty on patents. Again, this is available only to a resident individual who is registered as the inventor and has registered his invention under the Patent Act. And what is the deduction? Income by way of royalty or rupees 3 lakh, whichever is less. So the deduction shall be restricted to the royalty income, which includes the consideration for even the transfer of rights in the patent or for providing information for working or use of patent or use of a patent or rendering of services in connection with this. So this is not going to be available on the sale of products using those patents. Obviously, this is only available for the royalty, not for the sale of goods using those patents. Again, if you earn the royalty in foreign exchange, you have to realize within the 6 months. So this is how ATRRB is given. Now, all of these deductions, ATIA to ATIBA, IE, IAC, all those ATQQB, RRB, 10AA are not available if you exercise the option of concessional tax regimes. Clear? Yes, students. Any question? Yes? Any doubt? Any question?
Clear.
Clear? The next deduction in relation to the income that we are going to do is ATP. What is ATP for? It is for the cooperative societies. ATP is for the cooperative society. Deduction in respect of the income of the cooperative society. Now, what does it say? The specified income of a cooperative society would be allowed as a deduction. What is the deduction? 100% is the deduction in respect of profit and gains attributable to these activities of a cooperative society. Carrying on the business of banking or providing credit facility to the members. So if a cooperative society is a bank, a cooperative bank which is providing the credit to loans to the members or carrying out the banking activity, a cooperative bank's 100% of the profits are eligible for deduction under ATP. A cottage industry, which is operating as a cooperative society, marketing of the agricultural produce, which are grown by the members, purchase of agricultural produce, livestock, for the purpose of supplying to the members, the agricultural cooperative society, processing cooperative society, which are processing the agricultural produce without the aid of any power of its members. The labor cooperative society, which are providing the labor to its member. Fishing and other allied pursuits which are there. In all these cases, the 100% of the profits of the cooperative society are eligible for deduction under ATP. Are we clear? Then, in respect of the profit of primary cooperative society, again 100% of the profits will be eligible, which are engaged in the supplying milk, oil seeds, fruits or vegetables which are raised or grown by its members and which are supplying these food products or agricultural products to another federal cooperative society, to the government, then in that case they will be eligible for 100% of the profit. Then deduction in respect of other activities of cooperative society. A cooperative society which is engaged in any other activities beyond these activities, either independently or in addition to these activities, is entitled to a deduction of 50% of its 50,000 to the extent of its business activities. And in case of consumer cooperative society, the limit is 1 lakh. So let's say if a cooperative society is there which is engaged in any other business apart from these business, the business income will be allowed as a deduction subject to a maximum of 50,000. If it's a consumer cooperative society, 1 lakh. The interest or dividend income which is earned by the cooperative society, which is received on account of its investment with other cooperative society. So let's say if a housing society is there which is having its deposits with a cooperative bank, or which is holding the shares of other cooperative society, and any interest or dividend that it's earned, that will be entirely allowed as a deduction under ATP. Then a cooperative society which is earning the income from the letting of godowns or warehouses for the storage of the commodities, again that income is eligible for deduction under ATP. Then deduction in respect of interest on securities and income from house property. So in respect of cooperative society, where the gross total income of the cooperative society does not exceed 20,000, and it is not a housing society or an urban consumer society or a society carrying on transport business or engaged in the performance of manufacturing, right? Then if they have income from interest on securities or income from house property, that will be deductible under ATP. So basically all small societies. Okay. So this is a deduction available only in respect of the cooperative society. Any questions? Any doubt? What are non-eligible cooperative society? Cooperative banks. Other than the primary agricultural credit society and primary cooperative agriculture and rural development bank are not eligible to claim the deduction under ATP. However, if they are existing only to provide a credit facility and banking to its members, then they can claim the deduction under ATP. But if they are existing as a cooperative bank, which are giving the credit facility to the public in general, they are not eligible for ATP. And in case of cooperative society, if they claim the deduction under ATP, this will not be allowed under the concessional tax regime of 115 BAD and 115 BAE. Clear? Any questions, any doubt? Yes? Fine.
Is this primary cooperative agriculture and rural development banks outside this? Are they eligible for the deduction or they are not eligible? Primary cooperative agriculture.
Primary and all are there. Other than that, they are not. So that's what they are saying over here. So they are saying that the cooperative bank other than primary agricultural credit society are not eligible for ATP, meaning the primary agricultural credit society are eligible. Primary cooperative agriculture and rural development banks are eligible. Fine?
Okay, fine.
Okay. Now the last deduction for this particular chapter is in relation to the ATJJEE. A very, very important deduction. ATJJEE. Now, what is this deduction for? This is deduction in respect of the employment of new employees. This is not relating to any income. All the income-based deductions we have completed. This is in respect of employment of new employees. So this is eligible under the old as well as the new scheme under the concessional tax regimes also. What is it saying? Where the gross total income of an assessee to whom 44AB applies. So who is the eligible assessee for 80JJAA? An assessee is an eligible assessee to whom the tax audit is applicable under 44AD. Right? So to whom tax audit is applicable is eligible for 80JJAA. What are the conditions in respect of this? That the additional employees should be hired. The additional employees should be hired. Now, what are the additional employees? This excludes the employees whose salaries are greater than 25,000. If it is equal to 25,000, it is covered. If it is greater than 25,000, that is not an additional employee. An employee which is covered by EPS or EPF, Employee Pension Scheme or Employee Provident Fund, where the funds are, where the contribution is paid by the government, or the employee is covered by the employees who are not covered by the recognized provident fund. If the employees are not covered by recognized provident fund, they are excluded. Employees which are employed for less than 240 days during the particular year for which you are claiming the deduction. And in case if the business of the assessee is manufacturing of apparel, footwear, leather products, it is 150 days. So if the employee is employed for less than 240 or 150 days during that year, but in the next year, he is employed for more than 240 or 150 days, then you can claim the 80JJAA in the next year, not in the current year. Secondly, the business should not be formed by reconstruction or splitting up of existing business and should not be acquired by way of reorganization of existing business or transfer by way of reorganization. And the assessee should be furnishing the tax audit report within the due date of 44AB. Right? So in that case, the deduction will be given under 80JJAA for 30% of the additional employee cost. Now, additional employee costs include all the salaries, emoluments paid to the additional employee. The salary paid in cash or cross check is not considered. Employee contribution to PF or pension is not considered. Gratuity payments, termination payments are not considered. And this deduction is available for the period of 3 assessment years. Clear? Let us look at one question from the module. So let's see, Mr. Vikas has commenced the business of manufacture of computers. He employs 420 employees during the previous year. So you have to tell me whether this deduction will be available for these employees or not. The regular employees participate in the RPF while the casual employees do not. Compute the deduction, if any, for AY 25-26 if the profits derived from the manufacture of computer is 90 lakh and his total turnover is 11.48 crores. Would your answer be different if the Vikas has commenced the business of leather products on 1/4/2024? So let us first look at the first part. What about these 75 employees? Whether for this he will be eligible for deduction? Yes or no? Yes, right? These are employed on 1/4/2024. These are covered by recognized provident fund and their salary is less than 25,000. Right? So this we will cover it. Clear? What about the next 125 employees?
It's more than 25,000.
More than
Not
25, so not covered. What about the 120 employees?
not eligible.
Why?
They do not participate in recognized provident fund
Correct.
because they are casual employees.
Casual employees. So therefore, we will not cover them. Right?
Yes.
Next is 100 employees. What about the last 100?
I'm calculating number of days, just a moment.
Yeah.
Yeah, it is less than 240 days. So
Correct.
not
What if the assessee was in the business of manufacturing of leather? Then for these 100 employees, would we allow it? Yes. So if he is into normal business, this is less than 240 days, not allowed. But if he is into the manufacturing of leather, then it is more than 150 days. So then these 100 employees will also be considered, right? If he is into the normal business, then you will allow this in the next year. For these 24,000 salary, you will allow it in the next year if these employees remain for more than 240 days in the next year. Fine. Now, what is the deduction over here? Therefore, what will be the deduction? Therefore, only for the 75 employees. What will be the deduction? How will you calculate?
yes, 75 into 24,000 into 30%.
75 into 24,000 into 12 because this is monthly emoluments.
Yeah, yes, 12.
Into
Then
12 into 30%.
30%.
Correct? And in
64 lakh
case
80,000.
correct. And in case it's a leather business, then this will also include the other employees also, which is 24,000 into 7 into 100. So for these employees, 24,000 into 100 into 7 months because this is monthly emolument and this is starting in September. Fine?
Yes, fine.
Okay. So this is about the ATJJAA. Now this can be asked as a part of the full-fledged question. Now one or two more deductions are left out, which I will just quickly cover it. Deduction in respect of profit and gains from business of collecting and processing biodegradable waste is allowed as a deduction under 80JJAA if they are into this business of collecting and processing biodegradable waste, again to incentivize this business. 100% of the profits are allowed for the 5 consecutive assessment year beginning from the first year in which the business is commenced. Okay, so this is one of the deduction. And if this is whether it is available under 115 BAC or the concessional tax regime, the answer is no. This is only available in the normal tax regime. Next is ATL, deduction in respect of income of offshore banking units and IFSC. So again, this deduction is available under the old as well as the new scheme and in the concessional tax regime. Okay. So this is a deduction which is available to the scheduled bank, which is an offshore banking unit in SEZ, which is established like a bank established in SEZ. Any bank incorporated under the laws of country outside India and having a unit in the SEZ or a unit in IFSC. Any unit in IFSC, then this deduction shall be allowed with respect to the income of the banking unit or the income of the basically bank as per the Banking Regulation Act for an undertaking located in SEZ and which develops or operates or maintains an undertaking in SEZ, income from any unit of the IFSC from the business it does in the IFSC, or income from the transfer of the aircraft or ship or helicopter or an engine of an aircraft or helicopter which was leased by a unit of IFSC if they have commenced the operation before 31st March 25. Right, so this is basically for the unit of SEZ, which is a bank, or the units established in IFSC, which are doing the business over there or leasing the aircraft or ship or helicopter. What is the quantum of deduction for the SEZ bank? It is 100% for the first 5 years and 50% for the next 5 years. And from 23-24, the deduction is only 50% for the 5 consecutive assessment years. This has been enhanced to 100%. Okay? And this is allowed from the year in which the permission from the bank has been received. For the unit of IFSC, it is 100% for any 10 years out of the 15 years, any 10 years. Fine. So this is the deduction which is available under the old as well as the new scheme. And this finishes your deduction entirely. Yes, Samnithan, it was asked in the May 25 and on 80GGAA. You're right. So with this, we are finishing the deduction chapter. Now you are left with the two classes. What we are going to do in that? In the next class, we are going to solve the questions on PGPP. So I request you to revise the PGPP because we have not got time to solve the questions on PGPP. We are devoting an entire class on problem solving of PGPP. So go through, revise PGPP in detail because you will be required to solve the questions. Secondly, after that class, we will be starting with the assessment of various entities class. Clear? Any questions, any doubt you have before we close the session? Okay. Thank you so much, Jyoti. Okay, I think we can close the session if there are no questions. Yes. Thank you. Good night.